Hi, I'm Charlene Laney, co-founder of Newmaker Financial and Certified Financial Planner Professional. Today we'll be talking about a common tax planning strategy that actually may seem a little bit counterintuitive, and that is capital gains harvesting. Now, before I go any further, I do want to make it clear that I am not a tax professional, and none of what I'm about to say should be construed as individual tax advice. Okay, so with that out of the way, some folks that we work with, whether by inheritance or by their own savings, have significant balances in their taxable investment accounts. Balances that may very well be made up of deeply embedded capital gains from this last bull market. And when we say taxable accounts, we mean non-retirement accounts in which the sale of securities can result in a capital gains tax burden for them. So, knowing that the sale of securities that are at an unrealized capital gain can result in a further tax bill for you, why would you even want to harvest capital gains? And why would you sell a position when it's doing well? Well, for a few reasons. One, harvesting capital gains, in other words, selling all or a part of a position that sits at an unrealized gain. So it's a position that has done well for you over time. It helps to keep us accountable for selling securities when they're up. We all know that we want to buy low and sell high, but it's a lot easier said than done. However, when you are harvesting capital gains, you are doing precisely that. There's no disputing that you are selling high when you do so. So that locks in the gain for us that the market provided over X number of years. And of course, we know that what the market giveth, the market can taketh away. So harvesting gains allows us really to, do that process of taking chips off the table and helping to reduce the risk that market will take all of that back away. The second reason why we harvest capital gains is when we take the long view. I know that many of our clients view this category of their assets as their nest egg for retirement. And because taxable accounts are often the first place we withdraw from in retirement, and by the way, checking accounts are the same generally type of account in that when you make withdrawals from the account, those withdrawals aren't taxable. But within a taxable investment account, of course, we know there's that capital gains liability potential there. But because it is the first place that we withdraw from in terms of tax efficiency, just the textbook definition, not going to be the case for everybody, but for the most part, taxable accounts is where you draw from first. This does potentially, when you get to retirement, put us in a position to have to recognize more in capital gains and thus have a bigger tax bill than we would have had if we just sold slowly and methodically over time. It allows you to have more of this process in your control and to determine how and when you pay capital gains tax. So for example, say you're in retirement and all of your investments are what you need to pull from in order to live off of, assuming that there's no other sources of income like an annuity or a pension of some sort. If you need these assets to live off of, and had we not done any capital gains harvesting over time, you could potentially find yourself in a position, if these assets have done well enough, and if they've been invested for a certain amount of time, where you're selling it, and for every dollar that you're selling, 90 cents of that is unrealized capital gains. Well, if you need $100,000 to live off of, $90,000 of that will be liable for capital gains tax because that's all unrealized gains. So we certainly don't want to find ourselves in that worst case scenario. The third reason why we harvest capital gains is because of the fluidity of tax law. We know that this is something that changes, albeit not very easily. It does change, but with historically low income and capital gains tax rates, it is actually more likely that we'll see Congress increase capital gains rates rather than decrease them in our lifetime. In recent history, in fact, they have already floated the idea of increasing capital gains tax rates. So the tax bill that you could have on selling these gains today could very well be the least that you'd pay on the same sum of money in the future. So we want to take that into consideration as well. So to sum up, there are really a lot of reasons that you might consider harvesting capital gains as part of your tax planning strategy. Of course, it's generally good investing maintenance, like we talked about. We want to be able to spread out your tax burden over time, and we want to keep tax planning in your control by doing so. And then, of course, we have to consider the possibilities of future potential capital gains tax rates. As always, we encourage you to speak with your tax professional for tax advice specific to your individual situation. We are happy to partner with your tax professional that you currently work with, or if you need a good one to work with, we're happy to refer you to one in our network as well. Other than that, don't forget to like and subscribe. We will see you guys next week. Thanks.